Friends, in the trading day that just passed, global capital markets had their eyes locked dead on that December CPI report. In the end, the number froze at 2.7% year-over-year, with core CPI at 2.6% and 0.3% month-over-month. For short-term traders used to gambling on massive spikes, the second data drops. This report seemed way too mediocre. No hard-stopping jump, no delightful plunge. The market's reaction was pretty conflicted too, with both stocks and bonds falling into a brief sideways chop after the release. However, if we look past this seemingly calm surface and drill down into the muscle of the economy, we find an unsettling fact. This isn't a signal that the storm has passed, but the brief calm in the center of the eye of the storm. There's a common cognitive bias in the market that thinks bad news out is good news. And as long as inflation doesn't get worse, the Fed's path to cutting rates is clear. But this linear thinking ignores a much thornier structural problem, the zombification of inflation. Looking at the data, the 2.7% growth is exactly flat with November. Statistically, this means inflation readings have lost their downward momentum, stuck like a zombie in this awkward 2.5% to 3.5% range. For the Fed, this is absolutely not a victory, but a boundary of policy effectiveness. It declares that the traditional method of just relying on high rates to crush demand has already hit a glass ceiling against the current economic structure. From this, we have to be on guard because this stability is masking violent tectonic shifts happening inside inflation. If the inflation drop over the past year was due to luck and supply chain repairs, well, starting now, those freebies are all used up. Next, let's further dismantle the core of this CPI report. Why do we say inflation can't go down? The answer is hiding in two key sub-indicators. First is the end of the goods deflation bonus. Over the past year, a big reason the Fed saw inflation data drop was thanks to falling goods prices, especially used cars and durable goods. This provided a huge cushion for core inflation. However, the latest Manheim Used Vehicle Value Index shows that last month, the index rose 0.4% month. This is a turning point with massive signaling power. It means that the goods deflation effect that was helping out the Fed is slowly vanishing. Add in the shipping cost hikes from the Red Sea crisis and the rush to export ahead of expected tariffs, and commodity prices at the start of 2026 are highly likely to see a bounce. Second is the deep solidification of service sector inflation. Compared to the volatility of goods prices, service inflation is more like a chronic disease. There's a jaw-dropping detail in the data. The 12-month increase for motor vehicle insurance is about 2.8%. This isn't an isolated case. Medical services, home repairs, and other sectors highly tied to labor costs are still keeping up strong momentum. The essence of service inflation is wage inflation, and as long as the labor market doesn't see massive unemployment, this price pressure is very hard to eliminate through monetary policy transmission. This is the vanishing scissors gap dilemma the US economy is facing right now. On one hand, goods deflation, which was the anchor, is turning into inflation. On the other hand, service inflation, the engine, is still running a high fever. When these two forces stop offsetting each other and start pushing together, a CPI headlift is probably just a matter of time. Based on this microdata breakdown, we can make a qualitative judgment on the US macroeconomy for early 2026. This is typical mild stagflation. So-called mild stagflation means economic growth momentum has clearly weakened, with GDP growth slipping into the 1.5% to 2% range, showing a half-dead fatigue. But at the same time, inflation is like gum stuck to the bottom of your shoe, stubbornly stuck between 2.5% and 3.5%, impossible to shake off. The culprit causing this situation, aside from the structural shortage in the labor market, is the negative effect of tariff policies turning from expectation into reality. All last year, the US import price index rose by nearly 10%. This is a terrifying leading indicator. Artificially hiking prices on imported goods is essentially a negative shock to the supply side. This bill won't ultimately be paid by the exporting countries, but will filter down layer by layer, finally landing on the American consumer standing in front of a Walmart shelf. So against this macro backdrop, the Fed is trapped in a textbook impossible triangle. If they cut rates aggressively to save growth, they'll immediately detonate inflation expectations already pushed up by tariffs and services, causing a replay of the 1970s Great Inflation. If they keep rates high to pin down inflation, the already fragile real economy, and the massive $38 trillion US debt interest expense will directly trigger a liquidity crisis in the financial system. By now, we've seen the brutal truth behind this CPI report. This 2.7% number isn't a calm harbor, but the barometer's final reading before the storm. It marks that the Fed's efforts to control inflation with conventional means have failed. Even more ironic is that facing such a sticky economic situation, Powell, who holds the power of monetary policy, is right now facing an enemy that isn't just inflation, but a dimensional strike from the White House. Rumor has it the Trump administration has already bypassed the Fed, directly ordering Fannie Mae and Freddie Mac to smash $200 billion into buying MBS bonds. This isn't just intervention anymore. This is a power grab. When economic laws fail and political will starts forcibly taking the steering wheel, the real nuclear explosion point isn't the CPI data itself anymore, but that US debt interest spring being pulled to its limit. You could say that if we only stare at the inflation rate, we're making the mistake of missing the forest for the trees. What's truly keeping top Wall Street traders awake at night isn't a point or two of price fluctuation, but the malignant tumor cancerously growing on the US Treasury's ledger, the $38 trillion debt interest black hole. Let's look at a set of brutal data fit for the financial history books. According to the latest stats, in the just concluded fiscal year 2025, the US federal government's net interest expense officially broke the $1 trillion mark. What kind of concept is that? It means for every $7 the US government spends, $1 goes to paying off old debt interest. Even more ironic, this number has already exceeded the annual US defense budget. In other words, the resources this superpower now consumes on financial stability have surpassed its investment in global military hegemony. Historically, this is often a classic signal of an empire entering its twilight. But that's not even the scariest part. The scariest part is the self-replicating nature of this interest black hole. This brings us to the core concept of this video. The interest spring. Why call it a spring? Because it's a physical state of being suppressed while accumulating power, ready to snap back at any moment. We need to understand the structure of US debt. Currently, the Fed is in a high range of 3.5% to 3.75%, but the average financing cost of the US government's existing debt is currently only maintained at around 3.3%. That sounds reasonably safe, right? That is exactly the trap. This low 3.3% rate is dragging down the average, thanks to those cheap old debts issued during the zero interest rate era of the last decade, but bonds have maturities. Every day, tens of billions of dollars in old debt mature. The US Treasury must issue new debt to pay off the old, which in finance is called debt rollover. The situation now is, those old bonds with only 0.5% or 1% interest have matured, and the Treasury has to issue new bonds at a market rate of 4.5% or even higher to take over. It's like your mortgage originally a 1% rate. Now, the bank tells you the contract is up and the renewal rate is 5%. What happens to your monthly payment? It explodes. This is the interest spring being pulled tight. As long as the Fed maintains high rates for one day, the Treasury's replacement cost goes up a notch. Over time, that 3.3% average cost will inevitably move closer to the market rate. Once the average interest rate on existing debt breaks 4%, US annual interest expenses will head straight for $1.5 trillion or even $2 trillion. At that point, US finances will completely lose any room to maneuver. Other than printing money to pay debt, there is no other way. Under this fiscal crushing weight, Fed Chair Powell is stuck in a textbook dead end. Let's game out his decision tree. Path 1. Stick to fighting inflation. Keep rates high. This is the choice most aligned with a central bank's duty. But as mentioned, high rates accelerate the snapping of the interest spring. High borrowing costs won't just detonate commercial real estate and small-medium banks, but will push us finances directly into the ICU when the government has to slash spending because it can't pay the interest. A man-made deep recession becomes unavoidable. Path 2. Surrender to the Treasury. Cut rates drastically. This seems to be the market's hope right now. By cutting rates, artificially lower the government's financing costs and give the Treasury oxygen. But at what cost? Just as analyzed in the previous video, CPI is still stuck like a zombie at 2.7%. Against a backdrop of limited supply and labor shortages, rashly cutting rates is equivalent to letting the tiger back into the mountains. Once inflation expectations become unanchored, the dollar's credit foundation will collapse instantly. This is the nightmare moment of fiscal dominance. Monetary policy no longer serves price stability, but is forced to serve government debt financing. The market is very sharp. Did you notice? Before the CPI data came out, even though the market was betting on a rate cut, long-term US Treasury yields showed a weird rise instead of fall. What does that prove? It proves the bond vigilantes on Wall Street have already started moving. They are dumping long-term bonds. They are voting with their feet because they see through the trick, no matter what the Fed chooses. The future endgame is inevitably inflating away the debt. Since the dollars in hand are destined to depreciate in the future, they demand a higher risk premium right now. So, we see the real disease of the US economy clearly. It's not simply high or low inflation, nor just good or bad employment, but a fundamental conflict between monetary policy and fiscal policy. Powell wants to hit the brakes, while the Treasury has to slam on the gas. This car is rushing toward a cliff at 100 miles per hour. In a normal economic cycle, a central bank might still manage a soft landing through precise operations. But now, a new variable has appeared: direct intervention from the White House. When the DOJ starts threatening to sue the Fed chair on unprecedented grounds, and executive power tries to finger the nuclear button of currency issuance, this crisis turns from a simple math problem into a heart-pounding Game of Thrones. If the $38 trillion debt is the card on the table, then that hidden card Trump is preparing to play might be the real nuke that detonates the global market in 2026. According to multiple authoritative media reports, the US DOJ suddenly issued a criminal investigation threat against Fed Chair Powell. This wasn't for some major financial decision error. The reason sounds absolutely absurd, accusing him of suspected construction cost issues during the renovation of the Fed's Washington headquarters. Please savor this move. The helmsman of the global financial empire, the Fed chair who holds the power of life and death over trillions in liquidity, is being targeted by the DOJ because the renovation crew spent too much money on administrative trivia. This is obviously not a routine audit. Anyone with eyes can see this is a naked political coup. Powell's subsequent reaction confirmed the situation is extraordinary. He rarely released a video, not getting tangled in renovation details, but responding with extremely tough wording, saying this is an unprecedented threat to the Fed chair, pointing directly at the dangerous intent behind it to interfere with monetary policy through political pressure. Why now? Because as we analyzed earlier, the interest on $38 trillion debt has left the Treasury breathless. The White House desperately needs the Fed to cut rates for a transfusion, while Powell is still sticking to his last stubborn stand against inflation. Since the economic math doesn't add up, they start doing the political math. PGIM's chief investment officer compared this move to the US government scoring an own goal. It looks like a knock against Powell personally, but it's actually blowing up Fed independence, the bedrock of dollar credit. This behavior will undoubtedly trigger extreme unease in the markets. This renovation cost scandal might just be the prelude to the final battle. The real nuclear moment is actually locked in May 2026. That's when Powell's term as Fed chair officially ends. This was supposed to be a normal personnel change, but in the current macro context, it has turned into the biggest tail risk for global capital markets. The script the market fears most right now isn't Powell refusing to leave, but that Trump might appoint a crony or technocrat who obeys his every command to take over. This new chair's task would be singular: turn the Fed into the Treasury's ATM. This is the nightmare of fiscal dominance coming true, as known in economics. Once the new chair becomes a rubber stamp for the White House, monetary policy will no longer serve price stability, but fully serve lowering government borrowing costs to help the Treasury pay that $1 trillion in interest. The new chair might ignore the stickiness of 2.7% inflation and forcibly start aggressive rate cuts, or even restart bottomless quantitative easing. If that day really comes, the US dollar will no longer be money. but merely some paper issued by the US government. Strategists at Brown Brothers Harriman have already issued a warning. This threat to the central bank's credibility will accelerate the decline of the dollar's role as the main global reserve currency, because global investors understand one truth. A central bank that takes orders from the president is essentially no different from the central bank of Turkey or Argentina. And capital markets never listen to what politicians say, they only watch what they do. Facing this game of power, the smart money on Wall Street has already started voting with their feet. After the news of the DOJ threatening Powell broke, we observed a fundamental shift in market logic. First is the shaking of faith in the dollar index. Just on the Monday the news was released, the dollar index dropped significantly, ending the strong rally since the start of the year. This shows that the high interest rate logic originally supporting the dollar is being replaced by institutional risk logic. If the Fed is no longer independent, the dollar's institutional premium will instantly go to zero. Immediately after, the bond vigilantes started returning. Even though the Fed hasn't cut rates yet, long-term US Treasury yields are rising in panic. Bank of America strategist Michael Hartnett pointed out that bond vigilantes have become the new regulators. They are dumping US Treasuries, forcing yields up, because they know if the future is fiscal dominance, inflation is bound to spiral out of control, and the long bonds held now will be future waste paper. Even more alarming is the reignition of the Sell America theme. JP Morgan strategists keenly pointed out that this tension has revived the Sell America trading strategy. The selling here isn't just selling us stocks and bonds, but selling trust in the US financial governance system. Meanwhile, gold has already smashed through the $4,600 mark, and silver is seeing significant gains. This isn't hedging anymore. This is fleeing for your life. Funds are frantically looking for any hard assets not denominated in dollars, trying to get ashore safely before the coming monetary flood. So, we've completed the full puzzle of this macro storm in early 2026. From the CPI data, we saw the mild stagflation of zombie inflation. From the $38 trillion debt, we saw the Treasury struggling on the edge of the interest black hole. And here, we see the deadliest strike: political power trampling on the financial bottom line. These three forces weave together to form a perfect, reflexive death spiral. The more stubborn inflation is, the higher rates must stay. The higher the rates, the greater the fiscal interest pressure. The greater the fiscal pressure, the more radical the political intervention. The more radical the political intervention, the lower the central bank's credibility, ultimately leading to inflation expectations spiraling completely out of control. This is no longer a simple cyclical recession, but the ultimate stress test for the dollar standard. So, as ordinary investors, in this era where gods fight and mortals suffer, how do we protect our hard-earned wealth? Do we follow the wave of Sell America to embrace gold? Or do we look for opportunities to bottom-fish core assets in every crash? Simply put, we need to sell those financial assets supported by stories and PE ratios, and buy those physical assets supported by capacity and shortages. This brings us to the core track on our survival list, the new coal of the AI era. Here, there is an extremely important but often overlooked view by the market: focus on output stocks for AI development, especially nuclear energy and power infrastructure. This logic is hardcore. We analyzed in previous videos that the reason inflation is stubborn is because the supply side is limited. Against the backdrop of the AI arms race, what is missing the most? Not graphics cards, not code, but electricity. Training a large model consumes enough electricity to power a small town for a year, while tech giants across America are frantically building data centers. The US power grid is already overwhelmed. This is a physical constraint. In a stagflation environment, no matter if the economy is good or bad, tech giants must scramble to buy power at any cost to survive. This gives power suppliers extreme pricing power. Therefore, our strategy focus is no longer chasing those chip stocks with PE ratios in the hundreds, but lurking in nuclear energy and power infrastructure, especially nuclear, as one of the few energy sources that can provide all-weather, zero-carbon, high-power density. It is undergoing a historic value reevaluation, regardless of whether the Fed cuts rates, regardless of who runs the White House. To maintain US tech hegemony, Government fiscal spending will inevitably flow here directionally. This is one of the few searching dividends under the fiscal dominance script. And besides aggressive energy plays, we need defensive bottom positions. Utilities will be mentioned repeatedly lately. In many people's stereotypes, this is the most boring sector, a place where old folks collect dividends. But in the 2026 macro script, utilities are undergoing a qualitative change. Why? Because they possess the ultimate weapon against mild stagflation, cost pass-through mechanisms. When inflation is stuck at 2.7% and won't come down, or even rises to 3.5% due to tariffs, manufacturing will suffer profit losses due to rising costs, and consumer stocks will crash because regular folks have no money. But water, electricity, and gas companies won't. Their cost increases can be legally passed on to consumers through price hikes. Demand is rigid. No one is going to stop turning on lights or showering because of inflation. Even more key, with AI data centers craving power, utility companies are turning from bill collectors into shovel sellers. They are becoming an indispensable link in the AI industry chain. With US bond yields high and credit risks intensifying right now, these assets with administrative monopoly barriers, abundant cash flow, and growth potential are the best safe haven for funds. And with that, we have completed the full dissection of this macro monster of 2026. From the mediocrity of CPI data, we read the solidification of stagflation. From the pressure of $38 trillion debt, we read the dead end of interest. From the power games in Washington, we read the collapse of credit. Finally, in the survival guide, we found the arc of physical assets. In this era of the great dollar shift, the days of mindlessly buying the index and winning may be over. The Fed is no longer the guardian of the market. It is becoming a mud idol of politics. Future wealth doesn't belong to those who blindly believe the central bank is omnipotent, but to those who understand scarcity. In this era where electricity is tighter than computing power and credit is more expensive than gold, I hope these 4 deep dive deductions help you keep a clear head amidst the noisy market and defend your wealth territory. I am Ultra Ball Macro. Follow me to pierce through the fog of capital and see the truth of wealth transfer. See you in the next video.